Welcome back to the Double Play channel, where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using life insurance, you've come to the right place. So be sure to bookmark and like this channel, because you'll want to check out all the other videos that I've got on this subject. Today we're going to be straying a little bit from the double play theme again, because I want to spend some time talking about income from a life insurance retirement plan compared to income from an annuity. And this is important because most people are generally familiar with annuities, that they can provide income for life. But most people are not familiar with using life insurance as a retirement plan. So I want to highlight the difference and the fact that you can, and not only can you get income from a life insurance policy, but you can actually get more income from a life insurance policy compared to an annuity. So if this sounds interesting and you want to learn more, stick around after the intro and we'll get started. All right, thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and this is the Double Play channel. I created this channel because I know how hard it can be to research life insurance and real estate investing online. A lot of sites have pretty pictures and a lot of fluff, but they don't give you a lot of true information. They tell you that you should invest like the Rockefellers, but you've got to talk to one of their sales agents to find out how exactly that's done. And I think that it's best to just put all that information out there and free, because I'm pretty sure you want to deal with somebody that knows their stuff. So the goal of this channel is to give you everything that you need to know without ever talking to a life insurance agent about how to invest in real estate using the cash or leveraging the cash value of a life insurance policy. If you do have any questions, please be sure to post them in the comments down below, where everybody can see them and everybody can benefit from the answers. I generally get notified whenever somebody posts a comment on my videos, so I respond fairly quickly. So before we move on, I just want to go through my standard disclaimers. Everything we're going to talk about in this video today is purely educational. There's no tax advice, no legal advice, no financial advice. And the primary purpose of life insurance is for the death benefit protection. Any other benefit is purely ancillary. Be sure to go down to the description box right now and like and subscribe to this channel so that you're notified whenever I come out with any new videos. And if you're interested in this subject, you'll certainly want to check out all of my older videos. I've been cranking out these videos once a month for over the last 2.5 years now. So there's a lot of content out there. Just search the titles looking for whatever it is that you're interested in. And while you're down there, there's a link to buymeacoff.ee. If you're interested in supporting the production of these videos and you find this video helpful, please consider supporting the production of more of these videos. All right, so let's get started. The goal of this video is to show you how a life insurance retirement plan is capable of generating more income than an annuity. And again, I think that's important because most people aren't familiar with using life insurance as a retirement plan. And I just simply want to educate people, give you the opportunity to get the most bang for your buck from your retirement dollars, your savings dollars. And the way I'm going to do that is I'm just going to cover a little bit of the basics of both life insurance and annuities from the perspective of how they provide income. And then I'm just going to do a little bit of a comparison of both types of products and show you some numbers. While I'm going to be covering a little bit of the basics of life insurance in this presentation, I do want you to know that if you want to learn more, you should probably go out to my website and download my free ebook, Life Insurance 101. And there'll be a link to that down in the description box below. So, all right, so let's get started. All right, so let's talk about annuities first. Annuities were designed primarily for providing a lifetime income or for some defined period of time. and it's a return of product. It's a return of principal. So I think the easiest way to understand annuities is to think of it as a loan to the insurance company, and they're paying you back with principal and interest amortized over your life expectancy or whatever the period is. So to turn it around, I mean, most people are familiar with loans. You take a 5-year loan out to buy a car, you take a 30-year mortgage out to buy a house, and the bank is lending you money, and then you're paying them back principal and interest over that defined period of time, 5 years, 20 years, 30 years. Well, an annuity just flips that around. You're giving money to the insurance company, and the insurance company is paying you back. Once you annuitize the annuity, turn on the income, they're giving you back principal and interest amortized over some period of time. Whether it be a 10-year annuity, 20-year annuity, or income for life, in which case they just simply amortize it over your life expectancy. But I just want you to understand it. That's the best way to think of it, but that's not really what it's doing. I mean, an annuity is a financial product that you're buying, and you're buying that guaranteed benefit at some point in the future. So annuities are very flexible. They can be funded with a single premium or recurring premiums. They can be deferred. I mean, you can at age 65, you could drop in, say, $100,000 and immediately start taking income, or you can fund it with $1,000 a month from the time you're 30. So it's very flexible. You can set it up for lifetime income or for a defined period, and with or without a death benefit. And when I say death benefit, I'm primarily meaning, getting whatever money is left that you haven't gotten back can be paid out to your beneficiary upon death. But most of the time, like a lifetime annuity, once you die, the income ceases, and the insurance company, if you die before your life expectancy, the insurance company keeps the money. If you live longer, the insurance company keeps paying you the money, paying that person the money. So they rely on the large numbers in order to make this all work for everyone. And then the final bullet point is annuities can include critical and chronic illness riders in long-term care, for that matter. So these can be, particularly long-term care, can be extremely valuable because most of the policies that have long-term care benefits bundled in offered as some multiple of the face amount of the annuity. So if you have a $100,000 annuity, for example, that might give you $4,000 a year of income. However, if you had chronic illness or long-term care rider on that policy might give you the benefit of having $200,000 of face value, so a larger benefit. So those can be extremely valuable for people who have retirement assets and they don't particularly need the income. They can shift those assets into annuities that have the long-term care benefits built in. And that way all their assets aren't at risk if they become sick. They basically can boost up the power of that smaller annuity and turn it into more dollars of benefit than what the face amount of the annuity is. All right, I probably beat that to death, so let's move on to life insurance. All right, in life insurance policy, the cash value is essentially the policy owner saving up the death benefit over the lifetime of the insured. And if you put yourself in the position of the life insurance company, when they sell a permanent life insurance policy, whether that's a universal life or a whole life, they know they're going to have to pay a death benefit to someone someday. So the premium always includes some amount that goes into what's called the cash value, which is you or them saving up the death benefit over the lifetime of the insured. So with every passing year, the amount at risk to the insurance company goes down. But it's the cash value that we're talking about here that makes this so powerful. And that's the part that you need to understand. So the next bullet point is laws allow for overfunding of life insurance policies. So normally when a life insurance policy is sold, the insurance company is concerned about the costs. And people are concerned about the cost. They want to get, say, $1 million of death benefit for the lowest price they can. So the insurance company is looking at, what's the risk of paying out that $1 million, and what's the least amount of money I need to guarantee that contract or the performance on that contract. But when you overfund the policy, you're paying excess premium into the policy to ensure that it has more than enough cash value. So this is allowed, but it's only allowed up to certain limits. I mean, you can't prepay $1 million death benefit with $1 million of premium. So the government has limits on that. And then the next point is the statutes require that insurance companies make loans to their policy owners secured by the cash value of those policies. And almost more importantly is the last bullet point: if the interest is not paid, then the amount due is tacked on to the loan balance. And this is what allows for a life insurance retirement plan to work, because you're taking loans against your policy and you're never paying them back. And then ultimately, when you pass away, the death benefit of the life insurance policy repays the loans, and then your beneficiaries get whatever is left over. So let's just take a look at the Florida statutes that cover life insurance policy loans. So this is written in a lot of legalese, but if you look at the red underlined sections and string them together, it makes a lot more sense. So let me just kind of go through that. Section number 1 under section 627.458, there shall be a provision that after the policy has cash surrender value, the insurer will advance on proper assignment of the policy an amount equal to or less than the loan value of the policy. And the loan value of the policy is defined as being at least equal to the cash surrender value. So there you have it. The life insurance company must make loans to their policy owners secured by the cash value of the policy. And while this is Florida, all 50 states have language something like this in their statutes. Now, what really makes the life insurance retirement plan work is the second bullet point, and that's a second point, not bullet point. The policy may also provide that if interest on any indebtedness is not paid when due, such interest shall then be added to the existing indebtedness. And what that means is each year when the interest is due on the policy loan, the insurance company, if you don't pay it, the insurance company is just looking to see, does this policy have enough cash value collateral remaining that I can make a loan to him to pay myself the interest and then tack that onto the loan balance. So it's not like the insurance company is not getting money because you're not paying the interest. They're basically loaning you the money to pay themselves the interest and tacking it onto your loan balance. And this is extremely powerful. I mean, the best way to think of this is think about your house, for example. You may live in a house that's appreciating at 5% per year, but if you went into the bank and said, hey, since my house is appreciating at 5% per year, how about you loan me more money that I can use to pay you my mortgage payments, and you just tack that onto my bill? They would laugh you out of the bank because that's just not allowed. But here, I mean, I'm showing you the actual Florida statutes where this is written into law, and this is the law in all 50 states. So this is what makes a life insurance retirement plan possible. And I hope you can grasp just how powerful this is. So, all right, so let's move on and take a look at the comparison of the products. So side by side, let's look at life insurance retirement plan, LIRP, compared to an annuity. So let's start by looking at tax-free income. A life insurance retirement plan, because you're borrowing against the policy, is providing tax-free income. You don't get taxed on loans that you take. You borrow $300,000 from the bank to buy a house, for example. You don't get taxed on that as income. But annuity income is taxable. And I'll get into the taxation of annuities here shortly. Next one is tax-free growth, and both life insurance retirement plans and annuities offer tax-free growth. And the reason for that is that both life insurance and annuities are financial products that you're buying. They're not investments per se. The life insurance, I mean, really all you're doing is paying premiums in exchange for a death benefit. You've got access to that cash value, but that's just an added benefit. But really, the investing is being done by the insurance company, and then that's them, setting aside enough money to help offset the death benefit at some time in the future. So that's not really an investment per se. And the same is true with an annuity. You're buying a contract that will guarantee you income for life. It's not an investment. All right, the next one is leverage. And leverage is the key to life insurance retirement plan. It exists in life insurance, but it does not exist in an annuity. In an annuity, it's just simply a return of principal. You're getting paid back the money that you put in with interest. So all of the interest is taxable. And, the amount that's earning interest is going down because every month, every time they make a payment to you, your principal is going down. So there's less money being exposed to the market or whatever it is that they're investing in. Whereas with life insurance, your cash value never leaves the policy. You're taking income in the form of loans secured by the cash value. So 100% of the money keeps on growing. And not only that, with every passing year, the interest crediting or the dividends get added on to the cash value balance. So the cash value continues to grow even after you've started taking income. And if you're familiar with the rule of 72, for example, the rule of 72 is if you can take the interest rate that you're earning on your money and divide that into 72, that's the number of years that it takes to double your money. And that's a very useful rule of thumb in the financial world. So if your cash value, for example, is earning a 6% dividend, 6 into 72 is 12. So every 12 years, your cash value is doubling. So if you entered retirement with $1 million of cash value, 12 years later, your cash value would be up to $2 million. So that is what keeps up with the compounding loan balance that you've also got. And it's very, very powerful. And it allows a life insurance policy to provide income at roughly an 8% ratio of how much cash value you have at the time you retire. Meaning, if you had $1 million in cash value at age 65, you could expect to safely take loans of $8,000 per year for the rest of your life without ever exhausting the collateral. Now, if you're familiar with the 4% rule, if you're not, Google it. Don't take my word for it. But the 4% rule is just a rule of thumb that financial advisors use to determine the safe withdrawal rate from your retirement savings to not risk running out of money before you pass away. Now, annuities, traditional investments, all are subject to the 4% rule. That's more typical of how much income you can get from those types of instruments. And finally, the last line is death benefit protection. In life insurance, it's fairly obvious that's the purpose of life insurance, is to provide a death benefit protection. But in the case of an annuity, I just put a star next to that because really you can set up the annuity so that you get whatever money is left in the annuity given to your beneficiaries at the time of death. So now that we've covered the basic comparison, let's compare some numbers. So I struggled with how to present this for you because both are fairly complicated and both have many different options. I thought I would just do this more from a theoretical perspective rather than showing you complicated illustrations that are, would only apply to one particular person. So I'm using just a basic amortization schedule. Actually, it's not a schedule, it's just a calculator here, but well, I'm cutting out the rest of the spreadsheet. But we're just looking at just a typical Excel payment function. If you borrowed $1 million at 3% for 24 years, your payments would be $4,875. Flipping that around the other way, if you had an annuity with $1 million of cash value at the time that you annuitized it, and that annuity was paying 3%, it would be amortizing it over your lifetime, which is 24 years for a healthy, non-smoking 65-year-old. If you're curious, a healthy, non-smoking female, life expectancy at age 65 is 28 years. So that would result in a payment to you of $4,875 per year. Per month. I'm sorry, that calculation is per month. So I've done this for different interest rates. If you look off to the right from the 3% on the loan interest rate, you can see that I've got 4, 5, 6, and 7. Now, the payments are down below. So 4% is $5,407, 5% is $5,969, 6% is $6,560, and 7% is $7,178. Understand that these are all before tax. And the reason I decided against showing you the after-tax amounts is because it's different for every single person. In an annuity, it's a return of principal product. So you're not taxed on the $1 million in this example here. That is being spread out over 24 years. So every payment is including a little bit, or 1/24th. Well, in the case of monthly, it's more than that, right? But every year you're getting back 1/24th of your $1 million. So only the excess over that and below the payment is how much you're being taxed on the interest. So it's the interest that's really makes it the complicating factor here, because I'm simply looking at how much cash value we have at the time that you're retiring or beginning to take income. But we don't know how that $1 million got there. If it could be that you simply retired yesterday and took a distribution from your pension fund and rolled it over into an annuity that's going to pay you income for the rest of your life. Well, in that case, your basis is $1 million, and every single payment is going to include some portion of that $1 million being returned to you. But it could also be that you contributed $1,000 a month since you were 25 years old, and that accumulated to $1 million. In which case, your basis would be much, much lower, and your taxable income would be that much higher in that product, in that payment. So the answer is it all depends, and I just thought it's just not practical for me to show that to you. But what I want you to see here is compare these pre-tax or before tax numbers to the very last column on the right with the header life insurance. So in the life insurance policy, using the 8% rule, that's going to be $80,000 a year in loans, which works out to be $6,667 per month. So you can see that that's actually a little bit lower than the payment that you would get at the $7,000 or 7% level. But again, it's important to understand that the life insurance is already it's after tax. I shouldn't say already taxed. It's not already taxed. It's just coming to you tax-free because it's a loan. And once each of those other numbers, even the 7%, is taxed, it's going to be less than what the life insurance retirement plan is capable of providing. So takeaway here is that a life insurance retirement plan, even though most people don't think of life insurance as a retirement planning vehicle, is capable of generating more retirement income than an annuity. And the main power of this, what makes it possible, is the fact that All 50 states have language in their state statutes that require insurance companies to make loans to their policy owners secured by the cash value. And you don't have to pay the interest on it. They're literally loaning you the money to pay themselves the interest. So just wrapping things up, because of the leverage inherent in a life insurance policy, a life insurance retirement plan should provide more after-tax income than an annuity. So that concludes everything I've got on this subject. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I recommend going out to Facebook and join my Double Play group. I've got a link to that in the description down below. That is just a community that I set up of people who are my clients and many people who just watch these videos, find it, and are interested in learning, or who are doing it themselves and just want to, network with other people that are doing it. So it's a great place to ask questions without talking to an agent. Otherwise, I've got tons of other videos that you can watch on YouTube. Again, just look at the titles to find out something that is what you're looking for. And then my website, I think of it as a no fluff zone. I've got a ton of written information on my website. Usually there's a blog post that accompanies every single one of these videos that I put out. So if you prefer getting your information in a written form, or you just want to have an easy reference to go back to instead of watching this video all over again, you can go back and grab those, read those blog posts and bookmark them. And then finally, if you enjoy getting all this content for free, please consider supporting this channel at buymeacoff.ee. Again, the link is in the description box down below. So with that, I will see you in the next video.